DealQuest listeners and viewers, I am so excited to have Jay Offerdahl coming on an upcoming episode of DealQuest. Jay, you have such deal experience in terms of what you do every day. Tell us a little bit about what we're going to hear about on your episode of DealQuest.
Well, Corey, we're going to try to condense 25 years and 700 business transactions down into the kind of the key takeaways for the buyers and the sellers.
Love it. And I know we're going to talk probably a little bit about some trends going on and things we should be thinking about. And I know you're also big on sort of some mindset stuff. So tell me a little bit about what you think we'll talk about there.
Yeah, I mean, we're in some unique times right now with what's going around us. And I think buyers and sellers need to be thinking a lot about that, whether, if you own a business and you're thinking about your exit strategy or you're on the buy side, you're thinking about the right time to buy. Whether it's taxes or industry trends or multiples or risk factors and how to approach due diligence. I mean, I think we're going to hit a lot of neat topics that are important for anyone that's thinking about getting into business or currently in business to listen in on.
Hey, folks, so definitely check out Jay's episode on DealQuest.
Thanks, Corey.
Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On the show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My name is Corey Kupfer, and I've been supporting deal-driven growth for businesses for 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest podcast. Let's get started. I'm excited to welcome Jay Offerdahl to the program. Jay's father, Brad, was a serial entrepreneur growing up. Growing and selling 3 of his own businesses. Brad saw an opportunity to take his real-world knowledge to assist other closely held businesses with their exit strategy. After graduating from Appalachian State with a finance degree, Jay started working with his father at Viking Mergers Acquisitions in 1996, and in 2015 bought out his father, continuing to grow the business, opening up additional offices. Today, they have 9 offices and is the largest of its kind in the Southeast. He is recognized as a trusted top producing business intermediary in the Carolinas while helping lead and guide the Viking team with record growth. He is also a fellow EO member and former president of on the board and vice president of the Charlotte chapter. So he and I have that in common, that we are EO former presidents. And he's also served as the chairman of the Department of Finance Board at Appalachian State for over 10 years, helping to give back to students as his alma mater, lives in South Charlotte, and is happily married to Dina and has a blended family with 5 children. Jay, welcome to the program. So happy to have you.
Thank you, Corey, for the introduction. I appreciate that.
It's listen, we're going to get into some of the history in the background, and
definitely,
it's interesting because even there are so many deals, obviously, that you do for clients. Buying out your father's a deal, right?
Right. Absolutely.
So we'll get to all that, but I want to actually take you back even before this history of in the 90s coming into this business. When you were a little kid growing up, maybe 8, 10, 12 years old, what did you want to be? Because my guess is, an M&A banker, investment, banker, broker was probably not it, but maybe I'm wrong.
No, 100%. My dad was actually corporate America, selling, excavators and large earth moving equipment. And, I think a lot of kids when they're growing up just want to do what their parents do. And so when my dad did that, I want to do that. When he bought his first business, I'm going to do that. And then second and third. And then he literally sold the third one when I was a senior at Appalachian State. And I was like, well, what am I going to do now? Right. It's like, you got to get a job. Right. And so I did job interviewing and was figuring out if I was going to go the corporate route. And then he came and said, listen, I'm going to start this business brokerage industry. If you want to start with me from scratch, we'll be partners and see what happens. And so I felt like it was an opportunity that not a lot of people get. Sure. And there's good and bad to that, Corey. If you think about a lot of the friends that kind of went the corporate route before they got into business, they were used to managing people, divisions, balance sheets, profit and loss statements. Going straight out of college into entrepreneurship, you only know what you're exposed to. And it became something that, when in hindsight, I would never change it. But I realized when I bought my dad out and I was trying to learn how to work on a business instead of in a business, that everything was uncharted territory. So again, I wouldn't change it for anything, but it sometimes, as you know, people look from the outside, it looks a lot more glamorous than it was. There's a lot of challenges and hardship that you go through as you start to grow and scale a business.
No question about it. And I'm sure that that experience helps you have an understanding and empathy for the clients you work with as they've scaled something to the point where they're looking to exit it. One more question looking back, and that is, what was your first deal of any type? It could have been when you were a kid, older, whatever comes to mind.
Well, that's a good question. That the first deal I did in this business was a kiosk candy store in a mall that's no longer there anymore, out downtown Charlotte. And I remember it distinctly. It was $110,000, and I think we had like a $11,000 commission, and I thought I hit pay dirt. Right, I'm 22 years old and first deal, and I'm like, this is great, and it's obviously humbling to think back of where we started, and it's still humbling with what we do because the transactions are still challenging. They've obviously got some extra zeros at the end now from back then, but. It was, I look back at that in a fond memory. I mean, learning a business in the trenches, right? There's no substitution for time on the job. And that's how I tell people, like, I learned that from School of Hard Knocks. I learned from my father a lot what to do. And also, some things that he did, I didn't like. I had to learn things like what I don't want to duplicate or emulate or mirror from what, his management style and his approach. Very high integrity always. But he's a lot of like the typical type A boomer that they're very direct and I sugarcoat things a little bit more than my dad.
A little more diplomacy, huh?
Right, exactly. Try to, yes.
It's interesting. We talked a little bit about what in the bio and things like that generally. But you said a few more zeros, right? From that first deal. So talk a little bit about, we know that there's a concentration in the Southeast in terms of geography. You have the 9 offices you've grown. What size deals are you doing, or any particular industries that you focus in? Give us the landscape.
Yeah, we've been very intentional about the space we serve. Even though we've got the firepower and caliber, 3 CPAs, 2 attorneys, 20 prior business owners, a handful of people that went through the private equity group and managed deals for them. And we really could go further upstream, but we've been very intentional and still want to deal with what we define as the closely held business. So we really like industries that are service, manufacturing, distribution, and technology. We really like the ones that don't have, 10 or more shareholders. And the reason we open up these additional locations is we realized, especially when you start getting into the really big deals, which for me is, talking about $100 million transactions, which we stay away from. It's like a transaction. It's like monopoly money, and it's a transaction, and it just doesn't feel the same. And we like that relationship. We want to be able to see our clients, the sellers. We're mainly sell side representation. So if they were outside of a 2-hour radius, unless it's just an industry that we've really done well in, I don't want to be on a plane unless I'm doing it for fun. Yeah. And so I don't expect my advisors to be on a plane unless they're going on a plane for fun. And so that next level is a, Sunday through Thursday, 100,000 plus miles a year. And I don't, live to work. I want to work to live. And I want the people that are part of Viking to do the same. And so we've been very intentional about staying and bringing really that investment banker professionalism down to the closely held business. And I think, jury's out. I think it's working well. You never have it figured out, right? You always,
right.
Our deals, like I said before, it's very humbling because people hear me say all the time, we're only as good as our last deal. We're not guaranteed our next. So
despite the fact that
residual subscription-based model here, this is
exactly.
If I see a seller every 10 years, that's a repeat client.
Well, that's right. Right. I mean, you want to talk about one of the ultimate transactional. Not only are you helping people with transactions, but your business is transactional.
That's right.
And not your mentality. I know because I know how you deal with clients. But I mean, it's people. There aren't that many, especially on sell side, right? I mean, you do have serial acquirers, right? And on the buy side, there are some folks in the industry who will have regular deals from a acquisition company or a regular buyer. But but on sell side, how many companies does anybody sell in a given lifetime?
Right.
2, 3, most.
Right.
Most people,
right.
Most often one, right?
Yes.
So, all right. So, in terms of deal size, so it's in the tens of millions, but not hundreds.
We'll go single digit. $1 million, $2 million. There's a lot of more of those, obviously, than the 10, 20, 30, 40, 50. But they're far and few between. Again, if it's not a call, so we'll meet with 7 business owners for every one that everything matches up. And we're not saying no to 6 of them, right? It's timing, it's expectations on price, it's are they ready? I mean, a lot of business owners, and I tell people all the time, like, if I ask a question, I'm not being a smart aleck. I say, why do you start a business? And they always they go, well, because I want to be my own boss. Like, no, you start a business to sell it. I mean, that's it. I mean, yes, you want to control your own destiny. Yes, it's financial independence. Yes, it's all these things. But at the end of the day, I try to teach people and talk to people about, I've seen 600, maybe even now 700, I think 700 plus transactions over the last 25 years. And the common theme of people that have done well is knowing that there is an invisible ceiling that they will hit somewhere between years 7 and 10, unless they bring other people around them that are smarter to help break through that invisible ceiling. But they really need to think about when's the right time to turn equity into cash in their pocket. And not, you can't time it. It's kind of like the stock market, but you just have to have this feel like, you know what, it's ready. And I've left something on the table for the next person, right? Because the next person wants to be able to grow it also. So, the first thing I tell buyers is, you're not going to find the good news is that ongoing business, you're not going to find a perfect business. But if you did find a perfect business, don't buy it. Right. When you bring to the table, you're going to just mess it up, right? So find that business is making some really good money, and you look at the owner and it's like, this is doing well in spite of the owner, right? And so, but the seller's mentality needs to be more of, a lot of times the buyer's like, well, I'm going to buy this business and I want to bring my kids into it. I'm going to give it to them. Like, whoa. No. Did you buy your kids a sports car when they turned 16? No, because you knew they had to practice on something less powerful. Don't hand the keys over to a business that you started out of your garage in the trenches, and then your son or daughter comes in and they expect to be middle management, right? My joke about nepotism, right? It's we promote family values almost as much as we promote family members. Like, you can't do that. You've got to look at this business as a separate entity. You need to solidify your own retirement first. And then if you want to start a business with your son and daughter, or buy them a son and daughter, take a percentage of those proceeds, right? If you sell a business for $10 million, you're done. You're good. And hopefully, depending on your lifestyle. And then maybe you take $500,000 of that, or $1 million of that, or even a couple $100,000, and use that as a down payment for a much smaller business that you can coach them up and teach them up. But I really seen a lot, and the statistics are against second, third generations, for the most part, have a higher probability of not continuing the success, about 20-25% decline per generation.
Especially third generation.
Success stories, right? You hear the success stories, but there's so many against those.
Yeah, the stats on third generation are ridiculously bad.
Yes.
I mean, I think the exception to what you're saying in second generation, and I do think, people even on second generation should be thinking hard about what the best route is for them and for their kids. But sometimes, you have a child who's been in the business for a long time, working right under, the founder. And listen, you're a little different that you started your business with your dad, but obviously he had experience selling other bustices and you came in.
But I still bought him out, right? That's the other thing. If you're going to do that, don't give it to him.
That's right.
I still got a second on my house and a second on my investment properties and a personal guarantee, my wife's personal guarantee. I mean, if I don't make it, my dad has his money.
Right.
So it's an added incentive to get up and go to work every day because I didn't walk into this debt free. And there's still actually, 6 years later, I still got a pretty good amount of debt on that.
Mm-hmm.
So that's a thing that keeps you motivated, right? I'm still working because I have to, not because I want to.
100%. I think that's a great distinction, and sort of where I was heading, right? You can have, right. And by the way, I mean, and this applies, and people have heard me say this to employees as well. I'm a big believer in, and I always say almost never, because I can come up with a scenario or two where I'd make an exception. But, I should almost never give employees equity. First of all, if you really want them to think like owners, well, part of being an owner is taking on some risk, right? Like nobody starts a company without risk. And when you significantly de-risk the investment by the time employees are buying in, if they're not up for, putting some skin in the game, I got a problem. The only exception I'll make sometimes is occasionally you run into a situation where somebody's had a real long-term employee who's been very underpaid because, and now you say, okay, I want to, in honor of all of that extra work you put in that I didn't pay you for, I'm going to give you some equity. Most cases, though, when people say to me, when entrepreneurs, business owners say to me, well, they've been with me 15 years, 20 years, whatever, they've done a great job. My first question is, well, did you pay them well? And most often they say, yeah. I'm like, okay,
that's why they're there.
Then they've been paid well. Let them use some of that money to buy in for equity, but it's a similar conversation. And so it's funny because it makes me think of two things, in terms of what you were saying. One is that, on this point, on the employer side, I talk to entrepreneurs all the time, because some of us have an unrealistic expectation that our employees are going to be as dedicated as us, and we get upset when they're not. And I always say to them, they don't own the damn company, right? It's not their company. You got to take that into account. I hold a very high standard for my employees, and they do great, but it's different, right? But also, going back to the deal side, you talked about the fact that, unrealistic expectations on price, right? You talked about that's a challenge sometimes. And you also talked about leaving sort of some upside for the buyer, right? And, a counter, so the other half of that, and I talked about it sometime, I'd love to hear your experience, is sometimes sellers get upset when a buyer points out those gaps, because sometimes they're doing it to try to, negotiate purchase price, right? They say, your branding's outdated, your technology's up to date, your space needs updating, whatever it is, right? But there's a different way to relate to that as a seller, right? Like that's the buyer. The buyer's going through a process to try to figure out where they think they can make improvements.
Right.
And if they don't think they have that upside, they're not going to buy your company. So it's, I try to get my clients to recontextualize that, because the ego comes into play, right? Sometimes they get upset, Well,
the buyer pays for what the seller has accomplished. They buy it for the opportunity that they can realize, but they don't want to pay for that opportunity that they got to,
that's right,
realize. So it's one of those things also that most business owners don't run their business to maximize shareholder wealth, which is the goal of a public company. And that's often a lot of times where we start with kind of a seller's kind of a pre-sale checklist, right? Here are the things that you've just got to get in order before you can ever consider about going to market. Because when you do go to market, it does become emotional, especially for our closely held business owners that started this from their garage and grew it. And now it's part of their, either the business family, which their employees, and their business is like a baby to them.
Yep. And
so the reality is they're not thinking about how a lender or a buyer is going to look at their business, right? They're just putting out fires every day. They got their blinders on. We try to open their eyes to just some basic things about, inventory, furnished fixtures and equipment, your organizational chart, job descriptions, financial statements. I mean, just the basics of understanding your balance sheet and profit and loss statement, and trying to, instead of trying to figure out how in the end of November you can cut your profit in half in 30 days by the end of December, figure out how you can keep that accounting practices consistent from month to month, quarter to quarter, P&L to tax return, so that it's easy for a buyer, if they're going to hire a third party, CPA firm to do a quality of earnings, that everything ties in nicely You've got all your vendors, all your contracts are assignable. I mean, I can go on and on. I can do an hour just on that, Corey. But I mean, the reality is people don't think about their exit strategy. We know that statistically it's a very small percentage of people that ever think about, hey, this is, what I'm doing. I bought this business, or I started this business set up to sell it. And for them to very intentionally look at figuring out 2-3 years beforehand, hey, I want to exit on my timing and my terms, and don't want them to be dictated to me when some life event happens, right? I'm burned out. There's a scare or a death in health and those things I don't even like talking about, but life happens. It happens quickly sometimes, and those are the ones that aren't prepared, and they don't get to dictate the terms. They're dictated to them.
Well, that's right. That's a great point. And listen, there are certain things that you can rush to clean up, and then there are certain things that if you can't suddenly have consistent financial statements. So with for the last 3 years, in a month, right? You might be able to find all of your contracts that you didn't file well and go back to clients and get them to whatever. But you can scramble on some stuff, but you can't scramble on other stuff. And so what you're raising is something that we do a lot on the legal side, and any good broker or banker is going to help out. Accountants are going to help out. To put these clients through what I often call a pre-due diligence process. Like we all know what a buyer's going to be looking for, and you want to put them through a pre-due diligence process to make sure they're ready, they're set up, and also to find any of the issues, skeletons before. You don't want the buyer to be the one to find those.
And it lightens the load, so that because even if they do all that preliminary, the due diligence time period still feels to a lot of sellers and business owners like a second job. Yeah. And so just kind of preparing them so it's just not overwhelming. And then when they get a 3-page single type due diligence checklist that goes through not just the financial, but the human resources and legal and the organizations and the vendors and the customers. And and there's just on and on and on. It's like, how could they require this kind of stuff? And it's like, yeah, that's just part of it. Due diligence is the opportunity for a buyer, whether that's an individual, whether it's a private equity group, whether it's a strategic or a family office, it's an opportunity for them to assess risk. Yeah. And so they're going through there and they're piling through things and say, okay, what's the probability of the past historic financial performance continuing in the future, right? And the inverse of risk is the multiple. And so, first question always people say is like, hey, what is this trading for? I'm like, well, 4 to 14 times. Like, what do you mean? Like, yeah, it could be a huge range. There's so many intangibles when you're talking about what a business is worth. Now, if you get into a certain section or a category or NAICS, I can kind of narrow that down. But it's all over, right? There's just a wide range. Even the same industry have wide ranges of multiple because of the different ways the business is structured. Are they residential or commercial? Are they business to business, or are they business to consumer? Are their margins higher than, there's 25 things that go into the part.
Do they have a high concentration risk in a few clients? Do they
vendor concentration? People forget about that, right?
Yeah. In the wealth management industry where I do a bunch of stuff, age of clients matter because you're talking about people with money, and the older folks are dissipating assets, not gaining assets. So it's industry specific, it's company specific, it's all that stuff. 100%.
How transferable is the knowledge in the owner's head?
Let's take a break from the show for a minute so I can invite you to a new way to determine your deal readiness. I created a fast and easy assessment that will determine exactly how deal ready you are. Once you complete the assessment, I use your responses to identify the obstacles that are holding you back from being a deal-driven growth genius. It's as easy as heading to CoreyKupfer.com/assessment. That's CoreyKupfer.com/assessment and filling out a few multiple choice questions. I'll be checking in after the episode to see what your results are. Now back to the show.
And Corey, I'd be remiss if I didn't bring this up. If business owners go to seminars, one of the main things people preach, like, you've got to get a management team in place where, you work yourself out of a job and they're running the company. Well, as you know, as an EO member, this stat is all over EO. To qualify for EO, you've got to do over $1 million a year in sales, right? Yep. And we know that less than 10% of all the businesses, I think there's like 30 million businesses in the United States, less than 10% of those qualify to be an EO, right? Yeah. So that's just $1 million. You can't afford a board of directors if you're doing top line $1 million. You might not be able to afford a board of directors if your bottom line is $1 million. So you're talking about a very small percentage. So I always tell people, couple things. It took me 18 years to first start working on my business, right? And now I'm 6 years into it, and it's still a challenge. It's harder to work on it than it was to just do deals in the trenches. But the second thing is the probability of you scaling your business to where it's worth tens of millions of dollars and be able to sell for that high multiple to a private equity there's a very small percentage. My best guess is there's maybe 6 million of the 30 million that have any sort of like structure where it's not a single shingle. And of the 6 million, you're talking about probably just hundreds of thousands that really have that 8-figure value. So the rest of those business owners, there's nothing wrong with having a $2, $3, $4, $5 million. It's a great lifestyle. It's a great business, but you still need to know when the right time is to hand it to somebody else and maybe take some time off and you do it again. That's what my dad did. He did it 2 or 3 times, did it 3 times, 4 times with me. And I've seen that work for people. 7 to 10 years into it, figure out what's your next, what's your exit strategy.
That's right. And then, you're probably much more likely, right, not to be selling unless you happen to have, and I've seen business that side, get lucky in that they're in an industry where some roll up comes along, right. And they right. do get, there's some EO members I've represented that had that benefit and got nice multiples. But for the most part, if you're not, like you said, the far majority of this business is not going to be PE kind of buyers. So you can have a strategic buyer, or you can have an operator, right? Whether it's an existing strategic buyer that's in the space or related to the space or whatever, or you're going to have somebody who's going to come in and be an owner operator like you. Those are the most likely buyers for those types of businesses, right?
There is. Now the private equity is coming down into the single digits and,
because there's so much money out there.
And that's an option for some people. You got an attractive industry and you're at the point where you're like, okay, I want to take a little bit of this equity. So I'm a paper millionaire, right? On a piece of paper, I'm worth, $10 million. And the person says, but 8 of that's tied up in the value of my business.
Right.
There is opportunities for people to sell off and recapitalize where they sell off, 75%, retain some of it. And then the freeing part for the business owner is now they're growing on someone else's dime. Their retirement is solidified. They can invest that, stocks, bonds, mutual funds, and that's totally separate. And they're still paid to do what they do, but the load is probably lessened because there's a bigger back office taking over some of the administrative stuff that the business owner hated doing anyways. And so now I've seen that even more and more below the $10 million mark, where there's an opportunity for people to stay involved with the business, take some chips off the table, and then grow on someone else's dime. And again, you've heard it many times, that second bite of the apple. I know it's cliche, but people register. It makes sense. Like, oh, yeah, I take
chips off the table and get a second bite of the apple.
In 5 years from now, my 25% may be worth what my 75% was worth when I sold it originally. There's those, it's case per case, and people have to know going back to, if you are ahead of the curve and you figure out some basic things about your business and timing, you get to have a lot more options than when you're kind of forced in a corner and say, I've got to get this sold because of this happened.
Yeah, 100%. And that is an interesting trend. On how different financing options, private equity, minority invest in certain spaces have really come into the market. We talk about that. It's interesting. In the last probably, maybe only 10 episodes, I've had 2 other folks who are investment bankers, brokers in different aspects, right? And, one of the things that I would say on the show is that we actually don't only talk about M&A and investment bankers or whatever. We have all kinds of deals, licensing, strategic lines, joint ventures, whatever. But I happen to have, a few recently. And I think it's actually good because I'd love people to go back because they don't compete with each other. They're in different geographies, different industries, different whatever. And it's interesting to hear from the different folks, whether it was, I had Liz Nesvold back on episode 127, which is a few months ago, who is one of the top investment bankers in the wealth management, asset management, and fintech, space. Yeah. So that's a very specific area. And, she talked about the trend she's seeing. One of the things we're seeing in that space is very similar to what Jay just said, where investment money, private equity money, whatever, is going downstream, right? It's amazing how many financing options they are for external deals, for internal succession, for acquiring, books of business in that space that weren't available, pretty much at all almost 10 years ago.
Well, there's more deal flow, Corey, and they're lower multiples,
100%.
Right? So they can take, they can buy 3 or 4 $8 million companies at a lower multiple. And once they kind of hit that next level of buyer, the multiple goes up and they combine the cash flows and they create some economies of scale. And all of a sudden, That's why private equity, they all look like geniuses. They only, they don't all hit home runs every time, but when they do it, like that really is impressive.
Well, that's right. And the arbitrage factor on the multiple is a lot, is higher, even if they're paying, a higher multiple than traditionally that size of business would get. Once they combine, it together, they get the arbitrage and the multiple. We talked about this also a little bit with Jessica Fiakovich, who's also the member president of Colorado, who has a franchise business broker, out there, and again focuses in that geography. So it'll be interesting, listeners and viewers, to go back and listen to all three of these episodes, because it'll give you, different industries, different geographies, different whatever. But you're going to see some trends, different opinions. But you're going to see some trends on what's going on out there and what's common, whether it's at higher end, the lower end, out in the Midwest, on the East Coast, whatever, is a lot of money out there, and a huge amount of deal flow out there.
Yes.
So that's
seller's market right now, right? Because interest rates are low, money is abundant, lenders are fighting over deals. I mean, if especially even in the $10 million and below, the SBA lenders right now, there's if a strategic buyer buys a similar business, some of these lenders will go at zero down and provide working capital. So they'll buy a multi-million-dollar business and get money back at closing. I was like, how's that make sense? To me, it doesn't. On a side note, I don't think it's kind of like the housing thing. Like getting in with zero, and now you owe $3.5 million on a business that's worth $3 million. But the person guaranteeing it, and their corporate guarantee it with their existing business, and their, and the bank has to take on secondary collateral from the buyer. So I mean, they're putting their money where their mouth is, but it's just it's an awesome opportunity right now for a lot of sellers, especially because it is a seller's market to capitalize. That may change at the end of the year, right? We don't need to get into that right now, but the politics are out there.
Capital gains,
we're in the middle
all
of
that stuff.
Yep. This long-term capital gains tax. It's a scary thought process. People need to be aware and look at their options. And the reality is we're never I don't think we'll see them go down anytime in the future. And what I'm hearing is a lot of people saying is they think it's only going to go up about 5%, and that's really only on things in excess of $1 million. So does it hurt if you have a $10 million company and you pay an extra $450,000 in taxes, federal taxes? Absolutely, that's a kick, but it's a heck of a lot better than if it went to 39.6 and you had another $2 million of additional taxes. That's not fair.
No question. And here's something interesting. I did a couple of solo casts on on the podcast here on the capital gains, risk capital gains going up. And here's the interesting part, because listen, trust me, I do not want capital gains to go up to 39.6 personally. I think there's a value deal flow. Maybe there's some room in between. But here's the interesting part. What I want to make sure, and you can go back and listen to those episodes, is that you have to understand, even if capital gains went up 39.6%, we've been there before. And there was a time when the capital gains risk was at that and deal flow was huge, right? And the reason is because capital gains is a factor. It's a material factor, but you have to keep in mind, it's only one factor. There's all kinds of other factors in terms of how well the economy is doing, your sector is doing, who's in there looking to buy and consolidate, whatever it is. So, so I'm not denying that it's not a material factor, and that I think there's not a significant understanding of the market and history if you think just because capital gains, it guarantees that deal flow is going to totally disappear. That's not the case.
That's a good point. That's good. I do think, Corey, that when things are significant, people pause to absorb them. So whether that's 3 months or 3 years, there's going to be a little bit of like, hold on a second, let me process this, see what this really means to me. Because before, if I sold at $10 million and I was going to net, $7, roughly, I knew I could retire on that. Now I'm netting $5. That's maybe I need to work a couple more years and make up that difference. So to me, I think there'll be a pause. 5%, even at 5%, I think there'll be a 30, 60, 90, 120 day kind of like, all right, is this real? And is it going to go back down next year? And the midterm elections come through and people are like, no, okay, I'm ready to go. The bigger concern I have, and I'm not trying to bounce around too much, Corey, is just knowing these baby boomers like my dad and his friends, the business defines them as human beings a lot of times. And one of my fears, and this may sound selfish a little bit, because I do obviously, I provide for my family when we sell businesses, but we do try to really look and tell, listen, we're not all things to all people, but we do feel like you need professional representation. And just as importantly is you need to know to sell the business before things start declining, because the buyer and the lenders are always fearful when things start declining. Where's the bottom?
Oh, yeah.
And some of these boomers, 10,000 a day turning 70, I've literally had them tell me, I'll never sell. I'm going to die at my desk, or I'm going to break the key off on the lock on the way out. And those that are close to some of these, and those are people that are dealing with business, right? Accountants and attorneys and financial advisors and bankers and lenders and all those people, like, we owe it to them to say, you know what? If someone hasn't told you, that's not right. You've got an opportunity to create generational wealth. And I know that the business defines you, but you need to think about other people here. And maybe the new owner will let you stay until you pass along, but why don't you take care of your business family and your family by handing the reins over to someone that's, maybe it's not half your age, but younger than you are and more capable of continuing to grow this company. And that's my literally biggest fear over the next 14 years. This goes to 2034, 10,000 people a day, 2034, turning 70. Next, 13 years, I guess, that's my biggest fear, is that's a big part of the wealth in this country. And we want to make sure that it stays by transferring that at the right time.
Yeah, you raise a very interesting point, especially on the types of companies we're talking about here, is that how many entrepreneurs, it's not like we often say, and you said earlier, and I say it all the time, the business is their baby, right? But it's actually deeper than that, because when it's one thing to say it's your baby, then it's still separate from you. But when it becomes your identity, right? Which it does for a lot of folks. And listen, I remember, I'll just share a personal experience. I had built a very nice law firm, had an office down on Wall Street, big corner office, looking at the Statue of Liberty, and it was had a combination of my partnership being the verge of splitting up, and then 9/11, right, happening, and we were down 5 blocks from the World Trade Center, wow. And people don't often forget that actually the economy. We were heading towards a recession even before 9/11 hit, right? It was starting to be a tough economy. And I looked and I intellectually understood that the smart business move would be to scale down some expenses, right? Money was getting tight, deals weren't going on. Some of my corporate clients were running into trouble. I saw that there would be a contraction. But you know what? Not only did I like having my nice corner, office with the view of Statue of Liberty, but even deeper. It was part of my identity, right? I was this, lower middle class Brooklyn kid who had become this succcell, lawyer with a Wall Street office,
right?
And so I had to do a bunch of internal, work to really get connected to how much I had tied my business to my identity. And then let that go in a way that had me make really smart business decisions, right? Took a smaller office, cut down expenses, rode that time out, and came back and grew even stronger. Whereas if I didn't, do that, I could have been, crippled or out of business. So that identity thing's serious.
Perfect example. It's so hard for us to kind of take a step back sometimes and look at the big picture, because we do get those blinders on and just going through the challenges of life and work, and you walk in and your employees respect you and your customers respect you, and you have a sense of pride, and it's a tough thing to rip those hands off the reins.
But you alluded to a solution that I've actually used, which is you said, hey, maybe the buyer will let you stay around, right? And for some folks, they want a place to go, they want to be identified. But I've literally had deals that are about to fall apart that I was able to close by just guaranteeing the seller that they could keep their office for as long as they wanted.
Right.
That was
transition.
It's
hard because the buyer wants to, make sure that people know that they're the owner, and that's why they want to be an entrepreneur. But oftentimes it's freeing for the seller to now have someone else that's actually responsible for everything. That burden that they bore for the last 15, 20, 25 years. Now, when they leave it, whatever time they leave during the day, it's kind of like, I don't, every day is a Friday now, because that someone else got the responsibility, and I'm really good at sales, so I'm just going to go out and do sales. I mean, so I've seen a lot of times where the transition is freeing for the seller. Again, they're working because they want to, not because they have to. They eliminate all the back office stuff that they kind of hated, but they're really good with client interactions or sales or whatever they're what they enjoyed. And now they're not working 80 hours a week; they're working 30 hours a week, and it's neat. It's really neat to see those things happen. Now, the seller also though has to still let go of the reins.
Yes.
feel good being second in command.
100%, and that's sometimes difficult for folks,
that's right,
especially when they've grown something of it. You said two other things that one is I mean they're both one's really true, and one gives me a little bit of a counter trend to even if capital gains go up. The one is that so often sellers wait until things are on the downturn, right? Because when things are going well, it's sort of like, well, it's on autopilot. I'm making money. I saw a panel once with a bunch of billionaires, and I forget who said it, but the guy had gone bankrupt and then built it, back up to $1 billion business. And somebody asked him, why did you go bankrupt? And he said, I mistook a bull market for brilliance. I thought that was it's one of the best lines I've ever heard. Yeah. So everybody's a genius when when the market's strong, right? It comes up.
But the funny thing about the market is say when the gentleman that shine your shoes is giving you stock tips, it's time to get out.
Right. So when the economy's good, whatever, you can be running it efficiently, you can be running whatever, and but it gets covered up, and then what happens is they wait till things are turning bad, and then maybe the economy's going bad or their business is going down because they haven't adjusted, and now the buyers are afraid that it's a drop in knife, as they say, right? So that's something, that discipline to be able to, take some chips off the table or get out when, and listen, I'm not saying, and I don't think you're saying, some people say, oh, the market's, phenomenal, you should sell now. No, it's not it's a combination of life stage and what you want to do for your family and how much you want to be in your business. So I'm not saying it's the only factor. But if you are anywhere in the ballpark of considering, in the next 5 years or whatever, and you're at a place now where the capital gains rate stacks are great, and the market's overheated and there's a huge amount of money, you should at least give it a serious look.
You should, at a minimum, every business owner should know what their business is worth, even if they're not looking to sell. As part of your financial statement, you understand where you are. Your financial advisor can't paint a complete picture without that. It also, I've found, will kind of motivate business owners because, again, if your business is below 10 million, most people think it's worth a lot more. Yeah. A lot of people don't realize how valuable their business is when they're above that 10. So it's kind of this somewhere between 5 and 10 million where it kind of switches, and the business owner's like, well, it's really not that worth that much. Like, oh yeah, now you're getting a much higher multiple. But if someone's get some of the industries have lower multiples, and they look at the valuation like, if I just work 4 more years, I could get the same amount. Like, well, yes and no. Right now you're paying, ordinary income tax rates that are maxing out at 37 federal and, your state, and then all the few Social Security and all that. When you sell the business, a lot of that will be long-term capital gains rate. So the after-tax proceeds may be more like 5 to 7 years. And then the question is, do you want to work 5 to 7 more years to make the same amount of money, or do you want to have that all in one day? And if that doesn't motivate you, then you should continue to work. Or if you want to hit a certain goal. But here's the stake we put in the ground. And now you've got to determine, it took you 15 years to get to, $3 million. Do you really think you can double that in the next 5? I mean, maybe you can, but those are things, again, get in the rational part of things. It took you 15 years to get to this point. Try to do a couple things to tweak it. Try to maximize that value. Yes, 100%. But have realistic goals on what you can really scale and grow a company, because most people, including myself, I had to surround myself with
we're entrepreneurs, we're optimists.
We're right. Yeah.
I think that's generally a good trait, but when it comes to valuation and growth, I think we much more often overestimate, what we can do, at least in a few years, not a long.
That's right.
In a few years than what we really can, because we're always so optimistic. That's a fascinating. And the other thing that, is true is, in your example where, hey, you can and realistically after taxes, it'll take you more like 5 to 7 years. There's also risk in that 5 to 7 year period.
Tremendous.
Right? Economy goes down, valuations change. You get a competitor that comes in, you get a health issue, you get, whatever. So you're also taking risk off the table. So for me, if that has to be taken into account as well.
Right.
Yeah.
Most people are not selling to retire. They're selling because they're burned out or they've hit that invisible ceiling, and they're smart enough to realize it's time for someone else to take the next level. And that's also on another side note, that's the one time in your business career that you do need to be a little bit selfish. And I hear it so often, and it's not being mean by saying, hey, I've got my business family. It is your business family. And part of taking care of your business family is entrusting it that it's put in the right hands. But this is the one time, if you only do one transaction in your life, or even if you do two, or like my dad even doing 4, each one of those times you need to really put yourself and your family in the front of everybody else, because no one else in the world is putting you ahead of them. So this is the one time for you to be a little bit selfish and make sure that you do it on your terms and your timing.
Yeah. And that last comment I'll make, and then I want to solicit any last thoughts you have before I ask my final 2 questions. But, you mentioned this sort of 13-year trend with the baby boomers and, and whatever. And I think, that's just one of those factors that I do. Again, I'm not saying capital gains don't matter, but the fact that you've got, like demographics are a factor, right? And although some of those folks are going to die, with their boot, in their boots at the desk, whatever, you do have just demographics such that there's got to be, there's a chunk of business, a chunk of money, a chunk of value that's going to change hands in that next 13 years. And that's going to be a driving force, no matter what the tax rates are. Obviously, with lower rates, it'll be even a bigger force. But, at some point that, person who's in their late 50s or certainly 60s and 70s right now, is going to get to the life stage where, they're going to say, I've had enough.
You're right.
So that, that's a demographic factor. All right. So before I ask my last 2 questions, any particular sort of trends, things that you're seeing, anything that you want to bring up that you think would, be valuable to the audience in terms of deals or whatever?
I've been intrigued by how the type of buyers is increased. Some of that, I think that was because of COVID and people being furloughed and let go and working from home. They just kind of say, you know what, I'm tired of this. And so it's been interesting to see, like, literally the buyer inquiries have almost doubled from January, February, March of 2020 through, most recently. And the neat thing was the Great Recession of 2009 created a younger entrepreneur, because before 2009, most of the buyers were, hey, my kids are in high school or college, and now I'm going to take this risk. Yep. And the people saw in 2009 where someone that thought they were semi-retired is going back to just, be a greeter somewhere because their investments went to nothing. And it almost triggered, like, you know what, I'm going to do this risky thing now when I'm younger in my life and my kids are young, because if I don't make it, I've got a longer runway to recover. So that's kind of been interesting to see a really wider range of buyers and sellers. And even through the 2009, we've been selling some of those people's, millennial businesses for millions of dollars because they couldn't get a job and they're forced to be an entrepreneur. So that's kind of my neat thing. We're seeing those people now, 10, 11, 12 years later, that started something out of necessity, grow it to be an actually pretty neat business. But now they're thinking like, okay, this is all I know, kind of like me, right? I'm in uncharted territory. Every time we open a new office, every time I hit a new milestone, it's uncharted territory for me because I never ran into a vision for a big, company. But these young, started something in their 20s, now they're 33, 34, 35, and like, I need to hand this off to somebody else. That's been kind of a neat thing that I've seen recently with the wider range and backgrounds of buyers and sellers.
I love it. And then, and listen, we talk about serial entrepreneurs and some folks are like, well, what am I going to do if I sell my business? But I think nowadays, there are more folks who are saying, hey, I'll go do something else. Maybe I'll take some time off. Maybe I'll travel the world. Maybe I won't. Maybe I already have my next business idea, whatever it is.
That's what I tell them. What do I do when I retire? Whatever you want for a short time period. And most importantly, also with that identity thing is don't think about what you're leaving. Think about where you're going to, right? A lot of people are kind of looking behind them. Say, no, think about what you're going to. Are you going to give back to church, the community? Are you going to be a consultant or a coach? Are you going to take some time off, like you said, and travel? think forward, because then it makes it a lot easier and not as emotional than thinking about what you're leaving. Think about where you're going to. There's another chapter in your life. We have chapters all the time with kids, with homes, with all different types of things. This is a great chapter. You had a great run. You owned your business for 15, 20, 25 years. That's a great chapter in your life that you got a new chapter to look forward to.
Yeah. And creating that vision for what's next is absolutely so key. So before I ask you my final question, Jay, I'm sure people got a huge amount of value here. What's the, if they want to find out more about you and Viking, where do they go?
Our website is vikingmergers.com, and that's B as in Victor, IKING. Our phone number 704-676-0940. We've got great advisors. Like I said, 20 of them are prior business owners. So I tell people all the time, our secret sauce is empathy. We know what it's like to go through the challenges and successes of owning a business. And we like having conversations. We're low pressure. I always tell people I'm 47. I look 57. I act 67. I got 5 kids. I still got to work. So there's timing for me. We're ready when you're ready. But start the conversation. It doesn't have to be us, but start the conversation. Interview 2 or 3 firms. Figure out who is your total team, right? Who's your CPA that can get you through? Who's your attorney? Are they pro deal? Just because they got you out of your divorce doesn't mean they can get you out of your business.
That's right.
Make sure you got the right team around you, so that when you kind of do feel like you need to pull the trigger, it's easier to make that decision. You got your financial advisor. They've got that painted picture, like, okay, your business is worth this. Yes, if you did sell, you're good. Have your CPA, have that attorney, have the financial intermediary, the business intermediary, know who your team is, so that when you're ready to go, they're ready to go.
Love it, folks. And all that contact information will be in the show notes. If you're driving or whatever, don't worry about it. You'll be able to look it up. So Jay, my final question of the podcast is always about my highest ideal in life, which is freedom. And for me, that means everything from freedom from oppression for all people in the world to why I'm an entrepreneur and I haven't had a boss in 30-something years, except for my clients.
That's right.
So what does freedom mean to you, and how does it impact your business life?
Wow, you didn't prep me for that, Corey.
I don't prep. That's all I want to get the real answer.
Yeah, I know. I'm not very creative. The finance mind works with creativity in mind. So when I think of it, and I said it before, my goal is to be working because I want to, not because I have to. I think that's freeing. And until I get some of the from the buyouts paid off, I think that's still there. I'd love to be able to continue to give back. I think we at Viking, one of our things that we do well, and we've created a great culture of giving back, not just to the business community, but to what's important to us, whether it's our alma mater at Appalachian State, or it's to our church, or to those less fortunate. I think we're all put on this earth to do that. So I don't know if that creates the freedom, but I think when you're giving back, you feel better about yourself, right? It's not always about who you're doing, and you shouldn't do it selfishly to make yourself feel better, but it does. You do feel good when you give back to the community and to people that need it, right? And that's, I think, is best answer I can come up with.
No question about it. I believe in those values as well. Jay, thank you so much for being a guest on the DealQuest podcast. Really appreciate it.
That was fun.
All right. Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. I want to invite you to a unique way to tap into the wisdom and experience of the DealQuest community. Join the DealQuest Deal Den Zoom calls, a free monthly 90-minute mastermind. In the mastermind, we address all the challenges you may be facing and help support you with the opportunities that may arise in terms of deal-driven growth. You will get input not only from me, but all the members on the call will collaborate and serve each other in a mastermind format. To sign up for the free mastermind, go to www.corykupfer.com/dealden. That's corykupfer.com/dealden. I'll see you there. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.